What is up, everybody? It's your boy, Sean Grapevine, Program Director of Agent Direct. And thank you for joining us here on this topsy-turvy Monday market update. I am joined here this Monday, as with every Monday, by the Sultan of SLAs, the king of collateralized debt. He's the Colossus of credit, the Titan of the 10-year, the great Bambino, and he also makes sure that his long-term fixed income asset maturity lengths match the level of deposits in his depository FDIC insured institution. It is Austin Koenig. Welcome, Austin.
Thanks, Sean, and obviously a very current references here that you got going on. I like to see it.
We like to be topical, current. Really stay engaged for the kids.
No question. So yeah, quite a bit of drama to go over today, and I think the drama is not over by any means. We have a lot of, I guess, fallout, you could say, that's going to continue to happen during the week. And I think we can just get started with what happened at the end of last week. So obviously, kind of tailed into that at the end of the intro. SUB, we had a bank collapse, kind of like this is something that we haven't seen in a while, obviously, but we kind of all very well know the issues at hand here. Regardless if we are FDI, into bank regulation or not, we know that what the yields were in 2020, 2021 for mortgages, like basically any sort of U.S. Treasury was so much different than it is today, and everything is kind of, the music is essentially kind of stopping for a lot of these banks a little bit because they need to meet certain requirements, but they also have these different pools of long-term treasuries and short-term treasuries, or different types of fixed income assets that don't actually meet current market pricing, and that's because of this huge Fed ramp up and hikes. And we all know that through kind of what we've experienced, because I think us as mortgage professionals, we are at the first hand of real-time pricing, because we're not at a credit union where we're able to do jumbos at whatever price, or HELOCs at whatever price, or we're very market facing. So we've seen the market ramp up quite a bit in rates, and obviously we're seeing kind of the fallout right now, the flight to safety. But let's kind of get into the details. I guess first thing, like what questions do you have about this stuff?
Yeah, so I mean, I guess my question is wasn't this preventable, right? So my understanding is that essentially, Silicon Valley Bank, SVB, they have to hold a certain amount of money in reserve as a bank, because they have to be able to provide money back to depositors when they withdraw it, and that those withdrawals have been happening at a faster rate because credit is drying up a little bit in the tech market, right? Like, I get all that. And they were basically like holding very safe securities, right? Like treasury notes and 30-year like bonds, but kind of considering them same as cash. And it was like that same as cash consideration on long dated bonds that went down in value, that they would have had to wait 30 years or whatever, like 28 years for them to actually come back to their like actual value. And it just seems to me, it's like, why didn't somebody think about this? Like, when things go bad, they all go bad at the same time. Like, they could have seen that raising interest rates would have been the thing that caused depositors to cause net outflows of cash. Anyway, shouldn't this have been prevented?
I think there's obviously ways to prevent it, but I think this at the same time, this is a real life story of the risk of raising rates so quickly and at such an elevated level by the Federal Reserve. And kind of what you touched on there is exactly kind of is what happened currently to cause them to fail. But I think we have to kind of go back in time a little bit to think about what happened in 2020 with Silicon Valley Bank, because that kind of leads us to the final destination a little bit. So when Silicon Valley Bank, I think, received over 13 billion in deposits over the year, of like a net deposit gain of about 13 billion. And so, and kind of think about it like this too when we're thinking about the mortgage world as well. You guys are all very familiar. We had very low rates, and the reason why that was happening is because the Fed was buying tons of MBS and tons of treasuries, right? So they were providing tons of cash in the market by doing so, and they artificially created a very, very low rate, by reducing their rates down to zero and all that good stuff. So when Silicon Valley Bank received these deposits, think it like they have that 13 billion, but let's just kind of keep it down
Sure.
to a very simple number of like $100.
Mhm.
So their rate, that they wanted to lock in was maybe at a yield of about 2% or a little bit lower than that because, and they were looking at, I think, around 4 to 5 year term length, fixed income securities. The problem is, let's say that $100 makes me, when I get paid back at the end of that investment, I get paid back, $108. So,
Mhm.
great, I made that rate of return. But the problem now is, when we kind of what's the music happen and what's the music saying right now? If I need to go in and like, kind of cover my deposits, I need to go make $130 because the risk-free rate is this much, or kind of like that very real-time price security. That's what I should be yielding. The problem is whenever they need to sell that one that they bought 2 years ago, they might only get, 78, $80 for that $100 that they actually, invested back in
Mhm. Mhm.
early 2020.
Mhm.
So that's the problem right there is when they're having to take out, it kind of sell what's already underwater to an extent, like in terms
Mhm.
of real market pricing. When they have to sell that, they see a big loss, and so that's where, you know, 13 billion comes in, and they have to kind of invest it in some way. They can either lend it out,
Mhm.
for different types of loans, which is always good, but a lot of times banks also invest into really risk-free or as risk-free as possible securities. And so, unfortunately, the way the market's moved is they're not in risk of defaulting those securities in theory, right? But the issue is they're just not, they're not priced well in the market. Their mark
Right.
hasn't
The
taken
risk
down.
the the risk of like not being paid back is they're risk free, but the risk of them having, you know, like lower values at some point, that like they didn't take that part into account.
Exactly. So interest rate risk was not hedged properly, and that's actually a kind of a issue at a lot of banks. And I think every LO can probably attest this a little bit. They've seen credit unions and their probably local market not adjust to where everyone here at
Mhm.
UMortgage might have to originate at, like, for example, jumbo loans. Jumbo loans
Mhm.
are a fantastic example of this because it's a good business opportunity for a credit union. They want to get someone that has decent amount of money, decent amount of income into their banking business. So they'll go below market, but they don't necessarily need to price at the real time market because they're saying this is a longer term investment for me to get this customer, but also I'm feel comfortable with this yield. Well, the secondary market investors we have to face, and the non-dealt correspondent or broker community, they have to have a bigger yield and kind of are always real-time pricing. So that's why we see fluctuations in our day-to-day. But that credit union, even though the Fed's rate hiked rates 100 bips, you might not have seen much, if anything, in their pricing difference. So at the end of the day, the kind of music is coming to an end for a little bit of that, uh, you know out of pricing. Their kind of pricing is messed up. That pricing is kind of coming to an end, and they're having to figure out, one, how many banks are exposed on this, because at the end
Mhm.
of the day, Silicon Valley Bank was very unique in terms of their customer base.
Right.
But for those that
They have
are,
they
have
have
a
like
more
a
typical.
yeah, they have like a sort of like single agent uh risk as well, right? Like they basically all their depositors were essentially in the same industry, and all and when something happens to an entire industry, then you have this like shockwave effect of like, oh, everybody wants to withdraw their funds. Whereas like it sounds like traditional banks, right? Like they have consumers, they have small business, they have brick and mortars, they've got startups, they've also got car dealerships, and it's like unless like some huge systemic shock happens, it's not like every one of those is like, "Ah, I need to withdraw." Like a lot of those places have net inflows, right? So um, they had huge exposure to like one industry.
Correct. And that's actually kind of like the best way to kind of tail off into the story of why like Fannie and Freddie and just like general mortgage-backed securities have been so popular as an investment vehicle, as well as a vehicle for liquidity in the mortgage market. So the reason why we have such strong liquidity in the mortgage market typically is because of Fannie and Freddie and the ability to have mortgage-backed securities. So think about kind of like this, like if you were a small bank in a coal mining town, for example, right? That coal mine shuts down, if you lent everyone mortgages in that town, it's going to be a tough time, right? Because one, everyone probably lost their main source of income, but two, to find another source of income, they might have to move out of the town. So you think that real estate value for that town is not going to be doing well, right?
Right.
So generally, if that was just all those loans were done to that one bank, that bank could be at risk of possibly failing because of maybe a lot of loans and they're overexposed. But the reason why, if you were investing in a Fannie and Freddie bond, for example, this might not be a blip on the radar because at the end of the day, you're diversified by all the economies of the U.S. because the U.S. is just multiple micro economies all added into one, right? So at the end of the day, that's why it's so liquid is because of Fannie and Freddie and the kind of vehicle that we have here.
It really is amazing. And if anybody wants to read a fantastic book about the rise of mortgage-backed securities in the American bond markets, you should read Liar's Poker by Michael Lewis, same guy who wrote The Big Short. And it goes into detail about Louis Ranieri, who basically dreamed up the mortgage-backed security and then convinced the United States to convince various banks to buy and sell these things as speculative instruments, and is essentially the reason that we have jobs today, or at least have the jobs that we do have.
That is a great book. I actually highly recommend anyone. That is a great book. Like in the peak into Wall Street and how the world works over there when it comes to mortgage-backed securities. But also, you're exactly right. Kind of a genius of his time, but it also shows the craziness of that time as well.
Yeah. It shows how tame the mortgage world is by the 1980s standards.
Yeah, that's a great book, though. Highly recommend. One of my favorite books.
Same.
It's a great one right there. So, Liar's Poker is on everyone's reading list. I guess in terms of like what we should watch out for this week, obviously there's going to be a lot of market volatility. There's going to be a lot of news. There's even a Fed emergency meeting that's happening behind closed doors. We'll see what comes of that today. All else like that we have on the schedule, we have obviously CPI that comes out tomorrow, which is just another blip of information. But
another log on the fire, baby.
Just another log on the fire. But at the end of the day, too, what's very interesting about where we're at is if we look at last week, Monday morning, we were thinking, okay, there's 25 bips definitely baked in, but how much could there even be 50 bips? Goldman Sachs actually came out this morning and or actually on Sunday, and said that they are now revising it down to no hike in March. And so we do have a Fed meeting officially on the calendar at midweek next week. So Wednesday they would typically come out with possibly a rate hike that we'd expect.
What was their reasoning for the change?
Just for the fact that there's kind of the culmination of all these interest rate hikes have now shown the true colors of how much stress is being put on the banking system. And so the Fed might have to, while they think, their main goal is inflation and, the jobs numbers and trying to regulate the economy to kind of get to a soft landing, as, we've all been dreaming of, I guess, right? Mm-hmm. We've kind of hit a snag here. And that snag is essentially the stress that you're putting on the banking system and starting to see banks fail, and possibly the faith and if you're looking at all these equities, for example, in the banking world, a lot of the mid-sized regional banks, their stocks have been tanking, at the end of last week as well as this week. So while the Fed and the government has kind of come out with the FDIC to make sure that the FDIC can really shore up people's faith in the banking system, the stock market has a different approach because they're thinking about, well, okay, how much money they're actually going to be able to make in this case, how exposed are these banks to taking on pretty significant losses based off their investments that they've actually done. And think about it like this too. A lot of these banks don't have to kind of mark to market or essentially real time value a lot of these securities that are kind of held to maturity, for example, like we were kind of talking about earlier. So these are all different things that the market's having to digest at the same time. And as you can kind of see, we've had rates come down quite a bit. So the 10-year Treasury, is actually fluctuated below 350 this morning. The two-year note is actually down almost over 50 bips this morning as well. So we're seeing quite the reprice in the market, basically taking a lot of the Fed rate hikes out of the pricing of our, U.S. fixed income, Treasury, T-bills, and all that good stuff. It's all coming, back to a place of no more rate hikes.
Yeah, I mean,
And
but it's a crappy reason for no rate hikes, right? It's not like having a bunch of stress in the banking system has solved inflation, right? Like that, they're not related. So it seems like it just it seems like if you guys have one job, right? You got like one goal is to reduce inflation. And you're like, oh well, these banks didn't hedge. I mean, I guess you don't want a meltdown of the American banking system, but yeah, it's like, guys, let's just if we're gonna do it, let's do it. Don't wait around on poorly hedged banks.
And Sean, that's exactly what the Fed didn't want to do. But at the end of the day, like you said, the Fed has kind of been running at a full steam ahead, flooring the accelerator on the rate hike car. Essentially, the check engine light just went on, and there's starting to be smoke under the engine hood right now, right? And so it's a matter of, do they pull off the road or they keep on slamming the gas pedal? Like, they know there are things that are breaking at this point. And so, how do we fix that and tackle inflation? That's the trickiness, of what the Fed has to do here. So while, yeah, inflation's not fixed per se, or the way they want to see it fixed, right? They might have to take their foot off, because the way they've ramped it up so harshly over such a short period of time has displaced typical operating environments that banks are used to, and all that good stuff. So there's a lot of different things to take into account here, but this is all going to be kind of coming out in the next week or two, like how this is all going to be approached. And every day is going to be quite I'd say quite volatile over the next couple of days, because of things that will continue to come out, or things that will continue to actually subside, or figure itself out to an extent, and we'll kind of be able to get into a more coherent operating environment. But right now, there's a lot of emotions in the market, and a lot of repricing that's happening, and what actually ends up happening is yet to be determined for a lot of these banks that might be on the edge, or certain rate decisions that get made in the next week or so, as well as how does inflation even affect this. We'll see. I think there's going to be some sort of reaction to it, but at the end of the day, I think the banking system itself is more focus of the Fed right now, in terms of how much more ammo can we actually throw at this in terms of getting rate hikes up before we really cause unneeded extra stress that really shouldn't be part of our plan. So I think it's kind of seeing the real world implications of what they've done, and that's starting to really come into play. And I think they're kind of to take a second look at what they're doing and determine, okay, do we really need to go super aggressive here? If inflation's just our only target, we just want to not pay attention to anything else.
Right. Yeah. So it sounds like tomorrow will be a big day for that. So we ended last month at what, 6 point down to 6.4. Is that with CPI? Something like that. Do you know what the current economist expectations are for tomorrow?
So tomorrow the current is like 6.1 is our median forecast. So and then we also have kind of like the month over month one, which is about 0.5%. That is going to be consistent with what's expected this month, as well as 5.5 is the core percent. Last that was 5.6 was the core inflation last month when we saw that reading.
Sounds like expectations are for not a huge change, and
correct.
Certainly not big enough to get us down to 2% anytime soon.
No, exactly right. So that kind of inflation, expectation. If we get below that, that would be a good news for the market. But obviously, if we hit that expectations or it's worse than expectations, aka it's higher, inflation's higher than what was expected, I think that would be another really weird thing for the market to digest. So hopefully we can kind of get some news that can help row the boat in all the same direction. But we'll see what we get tomorrow, and it just kind of adds to the drama of the day. So
wow, I can't wait. I'm excited. It's like living through a soap opera. So all right, well, I'll let everybody get back to protecting your locks. Make sure that you're getting in front of any potential borrower shopping or anything like that. Remember, we've got the best float down policy in the world. It's called Other Lenders, and make sure that if somebody is going to switch and if somebody is shopping, that they end up switching just to us with a different lender. What do you think? You think there's any refis on the horizon? Some like September, October deals that we closed last year?
That's a great question. I think at the end of the day, if rates continue to go down, it just depends on what's best for your borrowers and their situation. I think a lot of things have to kind of go alongside with that. Be careful of any EPOs, obviously, but I think really when it comes down to it, there's times for the refis like that work well, and you just have to kind of be in touch with your borrowers, seeing review their mortgage with them, review how everything's going. Like do we think we have any sort of valuation gain that's happened in their market, for example, any equity that they want to tap into? We're kind of just strategizing, okay, do we want to wait this couple months, what's the kind of a payment that they want to lock in, and kind of just figure it out from there. So at the end of the day, it's you tapping into your borrower base, being that financial advisor for them, and seeing what makes sense. Sure, there could be in the money for refinances, but a lot of that stuff is going to be something they've done fairly recently, because all of your clients back in 2021 that locked in a purchase, they're not in the money, anytime soon. So.
They won't ever be. But all right, well, that's super helpful. We'll keep an eye out, and thanks again for joining me. Looking forward to tomorrow's CPI print, and guys, let us know if you have any questions in the comments, and if not, we'll see you next Monday. Go lock some loans.
Thanks. See you
guys.
Thanks,
Austin.